This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen. Welcome to the program. This is Dollars and Cents. My name is Joel Garris of Nelson Financial Planning. A finalist, we'll toot our own horn here at the intro, a finalist for a statewide award entitled 2018 Companies to Watch. So that's pretty cool. We'll see whether we are an award winner here in another month or so, but we're happy to have been named a finalist for such a prestigious distinction. You're listening to 93.1 and 540 AM. I've got it right, because that's a change. We're now on the other end of the dial here on Dollars and Cents on News Radio 93.1. So we've been up and down the dial over the years, and now we are at 93.1. So today is Sunday, September 9th. And as the calendar has it, you'll probably hear a lot over the course of the next couple of weeks, maybe the next 30 days, of a retrospect back to 2008. Why? Because it's the 10-year anniversary. Particularly this time of year is the 10-year anniversary of when the sky started to fall. Didn't totally fall in because we're still here, but it was a pretty major event. The Wall Street Journal weekend edition this weekend describes it as the world turned upside down. 2008, the world turned upside down. Dow went from a high point of 13,264 down to 8,776 within a very short period of time. I remember it was basically started in mid-September with the Lehman story, and then continued on just about through mid-November. And if you look at those 60 days, it was a 40% decline in the broad-based markets. Interestingly, and this is the part that people forget, half of that decline actually occurred in the first week in October. When it appeared that the folks in Congress were going to pass TARP, and that was going to sort of be the dam against the tide. But lo and behold, the folks in Washington didn't pass it. And I remember sitting in the office Friday before that week, and we had a meeting, myself, my father-in-law, Jack Nelson, our longtime associate, Frank Dass, and we were all sitting there saying, okay, well, what's next? What's going to happen? Because it had already been pretty dramatic. And the conclusion when we left that meeting was that, well, Congress will pass this bill, banks will get a bailout, and that will stem the tide. Little did we know then that coming into Monday, the folks in Congress decided not to pass the bill. Oops, that was a bad idea. I think that Monday the Dow went down almost 800 points. And for the week, the decline was about 20%. So it's one of those fascinating stories that sort of underlies the investment approach and philosophy that we have, which is that it's really hard to predict stuff. I mean, in that room on that Friday, with those three people, you probably had, well, shoot, I mean, there's probably close to 100 years of experience on that Friday in that conversation, all sitting believing that Congress was going to pass the bill because there's just no way they would not, because the U.S. government needed to shore up the system, if you will. And lo and behold, that's exactly what they didn't do. They did completely the opposite, underlying just how difficult it is to predict the future. Also underlying that most market moves actually happen within very short periods of time. And you've heard us give the statistics on many times before on that. You know, if you miss just a handful of days over a 10-year period of time, your return is significantly less, far more desirous to be consistent on your investment approach rather than believing that you can predict the future. What's interesting about 2008, obviously, the TARP stuff. If you recall the TARP and the bailouts that the federal government did, I was reading an article. You know, you're hearing a lot of these stories because it's now 10 years after the fact, and for whatever reason, 10 years is a measuring stick, and certainly that's a measuring stick that we use at the office, particularly if you're looking at the performance of investments. A 10-year number is always a good number to look at. I think a lot of the rankings or the ratings out there that you'll see are much more fixated on the 3-year and the 5-year number. And in our mind, the 10-year number really has to be the barometer, because that really takes you through all parts of the cycle. Of course, now with 2008 sort of folding off, we're actually going more to look at the 15-year number in the office when we're looking at the performance of funds, because the 15-year number would have now all of 2008 in there. And so if you're looking at performance, you want to get a handle on what that has been throughout an entire cycle. But in 2008, when you had 700 different banks getting some form of a bailout from the U.S. government, and some of those banks would argue, well, we were forced to accept the bailout, and I think that's probably part of the story as well. I think Henry Paulson, the Treasury Secretary at the time, wanted to make sure that the dam was extra, was extra wide and extra thick to prevent any more of the flood or the ripple effect of the of what was happening within the mortgage-backed securities market and how that was affecting bank balance sheets. And so TARP certainly did a tremendous value in terms of shoring up the system at that point in time. Had that may not have happened, then I think the results would have been much more disastrous. Even now, many people, and I guess I would agree with this, think of that 2008 time period as sort of this generation's brush with depression. Obviously it did not hit the scale of the Great Depression, but certainly many could say that was of the scale that could have very easily become much more than what it was. But certainly it has the tone and the tenor and the taste of a depression because it has really skewed a lot of perspective and approach. And you can still see it in some of the numbers that we want to share with you on the program today, because when you start to hear the numbers, you can really start to appreciate just how deep those wounds were from 2008 and how they still very much have ripple effects today that fundamentally still affect how people invest their money, how people borrow money. The numbers, when you start to kind of look at them in totality, are certainly pretty interesting, and we're going to get into all of that after we get back from the break. So stay tuned through the break, and we'll kind of have some more thoughts on the 10-year anniversary of the fall of 2008. And then, of course, we'll shift some gears as we make our way through the program. We'll talk about some tax stuff. Looks like the folks in Washington may be trying to do some changes to your 401k this fall. So we'll keep you up to speed on what the latest and greatest is on that here on the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on 93.1 WFLA. This is Joel Garris of Nelson Financial Planning, doing a little reflection, if you will, on 2008. 10 years ago, the world started to turn upside down. Started with Lehman Brothers and a massive bankruptcy that occurred with them, and then consequently the TARP money then getting voted down, and then Congress finally realized the mistake that they had made, or particularly the wrong message that they had sent, because the market obviously reacted pretty strongly. That was the 20% decline in 5 days. Not fun to sit in a financial office and go through that. The phone was ringing quite a bit, to say the least. And finally, on Friday, Congress passed the TARP bill. So over the next couple of weeks, 30 days, you're going to see a lot of reflections and conversation about it. The Wall Street Journal does a pretty good job about that as well in this weekend's edition. And many describe it as this generation's version of the Great Depression. Obviously not as severe, but when you look at a lot of the parallels, the Great Depression obviously created a elongated and exaggerated fear of a continued economic instability. And post-Great Depression, Americans decided to hold a lot of cash. The federal government became more of a guarantor of economic security. Banks got the federal deposit insurance. I mean, all of those things sort of happened after the Great Depression. Now, obviously, the global financial crisis in 2008 wasn't nearly as bad as that. But when you look at the kind of the results, right? I mean, bank regulations have really expanded, cross-border financial kind of trading and lending, that's also gone way down. The Federal Reserve, the government, has been at working very hard to make sure that they keep interest rates low. The same psychological effect that we saw after the Great Depression also appears post 2008. Households and investors are much more wary of taking on risk. You can see that in the yield on the Treasury bonds that are much lower interest rate on them, meaning that they're willing to accept a lot less of a return for something that has a higher level of safety. Here's one of the more compelling statistics that we've come across in terms of sort of how that risk-averse approach has become more instilled in Americans post-2008. If you look at the number of households who own stocks or mutual funds in the year 2007, that number was about 30%. So 30% of all American households held stocks or mutual funds in the year 2007, going into 2008. You know what that number is today? It's only 24%. That's a pretty significant shift in risk profile, in the ability of investors and households to get more comfortable. I mean, it's 10 years past. So much like the Great Depression, where you had that mentality that stayed with people for a long period of time, that made people much more conservative, there's certainly a lot of numbers and statistics that suggest that same thing is at play, and still very much in play post-2008, now 10 years later. That's just one statistic. 30% of households held stocks or mutual funds prior to 2008. That number today, still only 24%. Pretty dramatic in terms of the risk averseness that still exists out there, that ultimately means that folks are not investing like they used to. Now the good side of that is that when you have a system that has a lot less risk, then there is sort of less likelihood of any financial disruptions to really get out of control, okay? Because there's just less risk in the system. Whether it be, if you look at sort of things that have happened over the past few years, in 2013, when the Fed announced that they were going to reduce their buying of bonds, to the dramatic decline in oil prices in 2014, to Chinese currency devaluation in 2015, to the events of late in places like Turkey and Argentina. Those would be the types of events where, had you had more leverage or more risk in the system, where things could have gotten much more dramatic, and yet 13, 14, 15, and now you sort of made your way through those types of events without really a dramatic ripple. And this risk aversion post-2008 shows up in not just in the percentage of folks that own stocks or mutual funds, but it really does show itself also in the biggest asset that most Americans have, and that is your house. I mean, that's generally the biggest investment that people are going to make. In previous expansions, you've seen about 1.5 million new homes built each year. In this one, it is closer to 1 million, which is a significant difference, because that's a huge that's a per month, that's a per year number. So you kind of start to run that on a cumulative basis. Businesses also, when you look at business investment and its percentage of GDP relative to other cycles, it's much, much lower than what you would expect at this point in time. And certainly when you look at the percentage of home ownership rate, buying a house, getting a house is a very different proposition. Today, you are still a full 5 percentage points below in terms of the percentage of the population that owns a home, 5 full percentage points below where it was at its peak back in 2004. In 2004, homeownership rates peaked to 69.4%. Today, that number is only 64.4%. So still a full 5 percentage points of difference in terms of less people out there owning homes. But maybe one of the biggest reasons is that the average credit score on a purchase loan has increased dramatically over the course of the past 10 years. 10 years ago, the average credit score on a mortgage loan was about 705. Today, that number is about 745. So again, when you start to kind of look at these numbers and see the ripple effects that 2008 has had, and not just from the banking regulations and the low interest rates and what the effect has been with the Federal Reserve keeping interest rates low, but you start to see even now, 10 years later, those ripple effects. Investors are a lot more risk averse. Companies are a lot more risk averse. Investors are not owning as much on stocks or mutual funds than they did going into 2008. Businesses are not spending money; they're holding on to cash. There's less home ownership. It takes a better credit score to get a mortgage than it used to. All of that winds up really underscoring that the ripple effect that 2008 had and continues to have in the economy as a whole. And there's certainly an argument that can be made that because there's less risk in the system, whatever the headline event is, then you would wind up not having as dramatic a reaction to a shock to the system. And you can sort of see how that's played out when the Federal Reserve started to announce that they were going to pull back from reducing interest rates. You kind of look at the Chinese devaluation. You look at some of these things that have happened over the past 3 or 4 years that sort of did get ignored, but the economic system was able to sort of weather what could have turned into a much, much greater storm. So some interesting perspectives as we sit here 10 years post 2008 and the ripple effects that you continue to see. Certainly interesting to look at those statistics in terms of the number of households that today own stocks and mutual funds, and the fact that it's still much lower than what it was going into 2008. How much that's credit score? I mean, you've got to be a borrower in much better shape even today to get a loan to purchase a house, which is why the average age of a home buyer is the highest level that it's been in over 3 decades. So you start to see where the household formation and all of those numbers still are behind what they should be. And we believe that the conclusion that you can make from that is that whatever the shock is that sets off the next crisis, and there always is, because it's certainly, if you look through history, there's a cycle to this, that it might not be as dramatic as a 2008, simply because you just do not have as much risk in the system. So some interesting thoughts, hopefully, on the 2008 and some perspective and historical significance of that period of time. So we will take a break. When we get back from the break, we'll shift some gears and we'll talk about some tax stuff, some tax changes that you may not know of, and what the folks in Washington are looking at doing to your 401k potentially this fall. We'll do all of that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. A couple other statistics on some of the home buying stats that we were giving and how much that has changed since 2008. People already own their homes, aren't moving. The median tenure in a home is actually at the highest level that it's been in quite some time, which is, of course, because if people aren't moving because they can't find another house, that's creating a bit of a bottleneck for renters and folks who want to buy that first house. You're now seeing a smaller portion of homes being sold to first-time home buyers. And as we mentioned, those first-time home buyers are higher in age and have to have a credit score that is much higher, almost 40 points higher than what the average credit score was on a home loan back just 10 years ago. So we continue to see kind of the ripple effects on that. Certainly, there will always be another crisis because crises come, and the good thing about them is that they go. And if you fundamentally change how you invest money in anticipation that it's never going to go, then you're never going to have much of an investment return. And unfortunately, many people wind up in that situation. That's certainly a compelling statistic when you look at the percentage of ownership among households of stocks and mutual funds going into 2008. And the fact of the matter is that here we are, a market a whole lot higher than its highest point in 2008. And there's still a lot less households that are owning stocks or mutual funds. Certainly there will be something that starts the next crisis. Who knows what it is, but hindsight will always be perfect. And certainly when you look at a lot of the retrospect on 2008, that was 10 years ago. Many of those articles are particularly interesting because they help to give perspective of just how much that ripple continues today in how we do and approach things. So we will shift gears now in this portion of the program, talk a little bit about taxes, cover some tax changes that you may have missed, and then we'll also update you on the latest out of Washington from the folks in Congress who are looking at making some changes to your 401k. Some of this we have discussed in a previous program earlier this summer, but some of this also is kind of new as well. So we'll touch upon that. And then, of course, as always, if you would like to join the program and add in your topic on the show, then it's very simple to do that. You just need to pick up the phone and give us a call. That number, 407-916-5400, or toll-free 1-866-916-5400. Or you can send us an email. That email is my first name, Joel, Joel, at nelsonfinancialplanning.com. That's how you can get in touch with us on the program. So many of these tax changes that occurred late last year, folks have not seen on their tax return because they were, many of them were for 2018. And obviously, nobody's filed a 2018 tax return yet. It may come as a surprise that beyond the changes that you hear a lot about, like the higher standard deduction and those kinds of things, that there were also a number of the regular deductions that were done away with. One of them involves moving expenses. You used to, if you were moving for work, be able to write off your moving expenses. The new law basically eliminates this moving expense deduction until the year 2025. I mean, there is an important exception for active duty military, but it also, beyond that exception, anybody else will not be able to eliminate their moving expense deductions. Also, in that same vein, your deduction for unreimbursed employee business expenses. And this particularly affects those people that might use their own car, or that are more on the sales side, or constantly having to use their car or their phone or their computer, and the employer doesn't cover it. Those types of expenses, which were generally considered to be unreimbursed employee business expenses, that deduction has gone away. So you can no longer do those deductions as well. You can still, of course, if you get a 1099, you can still write those expenses off as a self-employed type of worker. But these expenses where you are working as a W-2 regular employee, the ability to write off business expenses has been eliminated. So you can no longer do that. We expect that to have the greatest impact in folks that would traditionally write off maybe some mileage on their car or similar things, that now you're not able to write that off at all. Also, another elimination is the deduction for casualty and theft losses. The exception to that is that if you are in a federally declared disaster area, but if you're not in a federally declared disaster area, the ability to write off theft or casualty losses is eliminated. Again, all of these eliminations with this tax code the way that it is, they all have sort of a sunset in the year 2025, which means that they, at least as it's currently written, they would all come back in that year 2025. But for now and for the next 7 years, they are gone. So no ability to take a casualty or theft loss at all. Many of those miscellaneous itemized deductions, the tax preparation fees, that also has gotten eliminated. Your ability to deduct your tax prep fee has gotten eliminated. Your ability to deduct your job search expenses also has been eliminated. Your ability to deduct your investment expenses, including investment management fees, has been eliminated as well. And what's interesting on that part is that when you look at a lot of these investment fees, this whole conversation about fees and fee only and those kinds of approaches, it used to be that you could write that stuff off. Now you can't. So that also comes back to looking at a little bit harder in terms of what those fees are, because now, without the tax deduction on it, you don't get any of those fees back like you typically would on your tax return. So that's important for investors to realize that deduction goes away, as we do often on the program. It's important to have a handle on what those investment expenses are, particularly now, because you're not able to write them off like you used to. So certainly a game changer for investors as well, not being able to write those types of expenses off. So those are some of the many things that were eliminated for the year 2018 through the year 2025. And so, again, most folks have not seen those play out on their tax return because nobody's filed a 2018. But just be aware, those are some of the many things that changed and were eliminated for the year 2018. We'll take a break. When we get back from the break, we'll talk about some of the things that are percolating up in Washington that are maybe changes to your 401k. So we'll give you the latest and greatest on that here on Dollars and Cents. This is Joel Garris on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. Also on 540 AM. Where there has not been a change, but obviously we are different now on 93.1. So we're glad you found us on this part of the dial. So talking a little bit about some of the changes on that are coming out of Washington that they're looking at doing to your 401k. We've talked a little bit about this in the past. Earlier this summer, it appears that we're going to hear more of this going forward because those folks up in Congress are looking at trying to do something differently on a variety of levels. And recently, President Trump signed an executive order that asked for regulators to explore ways to reduce required minimum distributions from 401ks and IRAs, which would make it easier. Also looking at trying to make it easier for small businesses to offer retirement plans to their employees. So there's certainly been some developments. We'll continue to talk a little bit about those developments, but we always like to hop over to the phones when we do have a caller. So we'll hop over there to Dennis. Good morning and welcome to the program.
Morning, Joel. My question for you is, given what we've been talking about, you guys have been talking about today, a 3.375 interest rate on a 30-year mortgage, do you pay that off or do you invest your extra money in the markets, in mutual funds and whatnot? What's your opinion on that? Assuming no other debt, assuming no consumer debt, how do you feel about that?
Sure, clean balance sheet except for the mortgage. You know, one of the things that I encourage folks to do is to try and go into retirement without even that mortgage. So I would suggest that. How far away are you from retirement, Dennis?
I'm 53, and that was my mindset too. I don't want to have that going into retirement.
Correct, and certainly I would agree with that. So you know, the pure financial decision would be, well, wait a minute, if I can invest and looking at historical rates of return 8 to 10% versus something that's only costing me under 3.5%, then on a pure financial decision, you would say, okay, well, I'm going to invest the money and I'll just pay the mortgage as the mortgage lays. But so much of what we do with our money is Dennis, beyond just the pure numbers part of it. And certainly when you look forward into retirement, to not have that mortgage certainly is where you want to be in retirement so that you don't have that big payment coming out. And you can use that money to, go have fun with, which is the whole point of why you want to retire in the first place. So I would look, Dennis, at maybe doing a self-imposed amortization. Is that like a 15-year or a 30-year mortgage, or how much time left is on that mortgage?
It's a 30-year, but I'm paying it down fairly quickly, so should be paid in 6 or 7 years at the rate I'm going now. And I am investing in my 401k and
that's good,
and those type of things. So it's not like I'm not throwing everything at it, but I do feel that the need to get that paid off.
Yeah, I mean, it's definitely a financial, you look just purely at the numbers, you'd come to one conclusion, but I think there's some emotional and retirement planning strategies in play that would say, hey, I want to make sure that I get this paid off. What I like to recommend to people, Dennis, is and that's fine that you're paying more on the mortgage, but maybe you're paying more than you have to. If you think about retirement at age 65, you said you were how old again?
53.
53. So that's 12 years. So what I might do is I might adjust how much I'm putting extra on that mortgage to make sure that it's fully paid off at, say, 65, which is sort of unless you're planning on retiring early, which is good as well. But if you look at 65 as sort of that age where you could become eligible for Medicare, get a little bit better health insurance option, then I always try and encourage people to sort of time that extra amount that you're putting on the mortgage to make sure it's all paid off when you, in fact, stop working, which, Dennis, I think in your case might free you up to maybe invest a little bit more of that and still be able to accomplish that goal of getting that mortgage paid off by the time you retire.
Gotcha. Thank you for the advice. I appreciate it.
All right, good stuff. Great question. And boy, I'll tell you, yeah, there's more to investing than just simply looking at the numbers. But going into retirement and not having a mortgage, obviously, that's a very good goal, and you want to time that goal with making sure that mortgage is paid off when you get to that retirement age. So it really depends upon you sitting down and thinking about, okay, well, when do I want to retire? The reason we sort of throw 65 out there is that is when you're eligible for Medicare. If you've ever priced out what health insurance costs at the age of 63, that's pretty pricey, whereby at least with Medicare, you do get some type of a plan that is a bit more cost effective than getting a pure private insurance type of plan. So certainly a good question, Dennis. We appreciate that. But beyond that, we certainly would encourage to get the mortgage paid off by the time you actually retire. But perhaps use some of that excess dollars to help fund more into those retirement accounts. Or, in fact, one of the things that we also like to encourage people to do is to do something beyond just a retirement account, because a retirement account, every time you take money out, is going to be taxable, is to look at sort of a after-tax or a non-retirement or a regular investment account where you could put some of that extra money in and ultimately have a pool of money where you could draw out lump sums out of, so that you could perhaps, if the roof leaks or something like that, then you've got a place to go where you could draw out some lump sums and not have as big a tax implications as if you had to do that on your retirement. So conceptually, how we like to think about it is that 401k money, that IRA money, okay, that's going to generate the normal monthly income that I need to cover my expenses. But then if I also have a regular investment account that's I've funded on an after-tax basis, then I can use that when I need bigger chunks of money and take money out of those types of accounts, which would allow me to be a little bit more tax efficient in retirement. So an additional thought on that question, Dennis, in terms of where to put that extra money. We are out of time, so we will wrap it up. We will start next week's program with a fuller conversation on some of these tax changes that are being kicked around in Washington. We did not get to that topic today, so we'll get to that next week here on the program, Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and you've been listening to News Radio 93.1 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.
Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit NelsonFinancialPlanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC at FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.